In this video, I'm going to continue talking about adjusting entries. Just in case you didn't watch the previous videos, adjusting entries are done at the end of the accounting cycle, which typically means year end, but some companies also do adjusting entries at month end. You're recording revenues in the period earned, recording expenses in the period incurred, and updating asset and liability accounts. And these are some different types of adjusting entries you might see. I've already talked about deferrals. I've already talked about accrued expenses. And in this video, I'm going to talk about accrued revenues. An accrual is an asset or liability. It represents revenue or income or expenses that are receivable or payable. In other words, cash hasn't been exchanged yet. For an expense, that would be an expense that's been incurred but not paid yet. And for a revenue, that would be revenue the business earned, but they haven't received payment yet. Basically, what would happen is at year end, the business would make sure all the revenue that they've earned has been recorded, even if they haven't received the cash yet. Now, this could be jobs they've completed, and for whatever reason, they haven't received payment yet. They would want to make sure those revenues are recorded. Or it could be some sort of job or service that they've completed part of it, but not the entire thing. For example, maybe they have a job, they're providing a service that's going to take 3-4 months to complete. At year end, they might look at that job and look at how much of that job have they completed by year end, and then record that amount. The actual adjusting entry would be a receivable to show that they have not received the money for that income yet. And then they would also record revenue to represent the revenue they have earned. And I thought it would be good to just put a refresher for debits and credits in here since I'm doing so many debits and credits and journal entries in these videos. A receivable is an asset. You would be debiting to add or increase the asset, and a credit would be to decrease the asset. And then we're also going to be doing entries to revenue. For revenue, you add to revenue with a credit, subtract from revenue with a debit. So I'm going to walk through an example. In this example, let's assume this company contracted with a client to perform a service. This service started on December 1st, 2025, and will end on January 31st, 2026. So it's a 2-month job or service. And in this example, payment of $3,000 will be received when they complete the job on January 31st. So they're going to work on this job for 2 months and then receive payment at the end. By year end, they might be doing their adjusting entries, and they might look at this situation and try to figure out how much of the revenue they've earned so far so they can record that revenue. So if by year end, half of the revenue has been earned, then they would want to record that half that they've earned. So in other words, they've worked on it for 1 month already out of the 2 months that the job is going to take. Now, they don't have to do it by time. They could do it by percentage. They might look at stopping points in that project and they might say, okay, we've earned 30% or 70%. It doesn't necessarily have to be based on time, but this was just the example that I decided to use. So they would do an adjusting entry to accrue service revenue that they have earned up to year end. Half of 3,000 would be 1,500. So in other words, they're going to record $1,500 of revenue. They haven't received it yet, so it's not cash. It's going to be a receivable. So this is what the actual entry would look like. It would be a debit to add to accounts receivable to show that the customer owes $1,500 based on what they've completed so far. And then they would credit revenue to show that they've earned $1,500 of revenue so far. And this entry would be done on December 31st, 2025. And then on January 31st of the following year in 2026, they would finish the job and they would have earned the rest of the revenue, the other half. They would receive payment from the customer on January 31st of 2026. So you would have a journal entry to record receipt of the payment from the customer and the remaining revenue that they earned. This would be what the journal entry would look like. They would have a debit to either cash or checking for the $3,000 they receive from the customer. They would have a credit to accounts receivable to subtract from accounts receivable. In other words, if I go back to the previous slide, here it was a debit to accounts receivable for $1,500 to show that they expected to receive that payment from the customer. And then here we're doing a credit to show that January 31st came and the company received that payment, so it's no longer a receivable. And then they also would have a credit to revenue for the remaining half that they earned in 2026. I want to look at that in the T accounts just to make sure that it's clear. In 2025, they would have this adjusting entry where they would debit accounts receivable to show they expect to receive this amount from the customer as of December 31st. And then this credit to revenue shows that they've earned $1,500 so far. And then in 2026, they did the second entry to show they received the $3,000 that went to checking. The customer no longer owes the $1,500 since that customer satisfied paying the job in full. So we can zero out the accounts receivable account by doing a credit. And then over here in revenue, the company would be recording the $1,500 they earned in 2026. So if you were to get the balances in 2026 after these transactions were completed, checking has a balance of $3,000 to reflect the business having $3,000 from this job. Accounts receivable has been zeroed out to represent the fact that the customer has paid their balance, paid for the job, and $3,000 total in service revenue to show that the company earned this much revenue. All I did with the adjustment is split the revenue into 2 different years to reflect when they earned the money. $1,500 was earned and recorded in 2025, and $1,500 was earned and recorded in 2026. And that's all I wanted to cover in this video. I'm going to do some more adjusting entry videos, and we'll come back to this with more examples and some worksheets at a later point. I hope you found this video helpful. If you have any questions, feel free to comment below, and I'll see you in the next lesson.